We are going to discuss how risk factors in loans and the lending rates are determined in this talk. Lending rate. Lending rate is the main reflection of a loan risk. How do banks determine a lending rate? Central bank discount rates. The discussion of lending rates helps us understand the practice of commercial banks. It also helps us understand the policies of the central banks. Discount rate of the central banks are the lending rates of the central governments. Discount rate is the main tool governments and central banks use to fine-tune economic activities. Risk factors. We will examine some risk factors that affect loan rate. Salvage ratio, ratio of self-funding in the project, uncertainty, project duration, and diversification. We'll study them one by one. First, we'll look at the level of return on assets in financial institutions. In January 2018, Bank of Canada overnight rate is 1.25. At that time, the prime rate from major Canadian banks is 3.45%. This rate differential is 220 basis points. This is a rough approximation of return on assets in financial institutions. More information on prime rate can be found on this following website. Comments. Rate of return on financial assets at around 200 basis points are very low. This is because financial transactions are very simple. They usually can't earn high returns. Banks have two ways to earn high return on capital. First, banks can increase leverage ratio. This is the traditional method. More recently, banks securitize their assets, such as mortgages, and sell them to third parties. They can continue to earn income from managing these assets, but they pass the risks to third parties. The first type risk factor we are going to discuss is the salvage ratio. Different businesses and different types of loans have different salvage ratios. Real estate mortgages usually have high salvage ratios. High-tech companies usually have low salvage ratios. How salvage ratios affect loan rates? We can work on an example to determine how salvage ratios affect loan rates. Banks charge interest rate based on risk of loans. Assume the bank's borrowing rate is 1% per annum. A business applies for 1 million loan for a project and plans to repay the loan in 1 year. A loan officer estimates the payoff from the project will be 2 million with 85% probability and 0.8 million with 15% probability. If a loan defaults, on average, a bank can get 6% of the salvage value. If the bank requires 2% return on its loan, What would be the loan rate? Solution: if the project payment is 0.8 million, the company will declare bankruptcy and the bank will receive 0.8 times 60% equal to 0.48 million. If the project payment is 2 million and the loan rate is X, the bank will receive 1 plus X million. Overall, the bank is expected to receive 1 plus X times 85% probability plus 0.48 times 15% probability. That is equal to 1 plus 1% plus 2%. Here 1% is the bank's cost of borrowing. 2% is the bank's required rate of return on its loans. We can solve the above equation to get x equal to 12.7%. This is the loan rate. So the loan rate is a reflection of downward risk. If the salvage ratio is increased to 80%, the interest rate will be 9.88%. This is lower than 12.71% in the previous case. When the salvage ratio is higher, the loan rate is lower. If the credit and judicial systems can increase the ratio of salvage value, the loan rate will decline. Judicial systems and salvage ratio. In US and Canada, Chapter 11 Bankruptcy Code and CCAA, Companies Creditors Arrangement Act, allow debtors to stop interest payment while restructuring their businesses. In continental Europe, when debtors could not pay out interest, creditors can take over the assets swiftly. This often increases the salvage ratio. The differences in judicial systems reflect the differences of abundance of resources. In resource-rich societies, such as North America, there are more opportunities to turn around businesses. Judicial systems give business more chances. In resource-poor societies, there are less opportunities. Judicial systems act swiftly to reduce further waste. Bonds and stocks. Bond owners have high priority in claiming assets over stock owners. Bonds have higher salvage values than stocks. This is one reason cash flows from bonds are discounted at lower rates than cash flows from stocks. Financing choice: debt or equity. For high-risk projects, debt financing will incur high interest rate. We generally choose equity financing. In general, low-risk projects use debt financing. High-risk projects use equity financing. Some projects use a mix of debt and equity financing. Low-risk tranche use debt financing, and high-risk tranche use equity financing. The general principle of financing: type of financing should match type of project cash flows. Less variable project cash flows should use debt financing. This will lower the payment rate with the interest. More variable project cash flows should use equity financing. This allows more flexible payments with dividends. Next, we discuss ratio of self-funding and the loan rate. Some companies or investment projects fund more with their own money, some with less their own money. How does the ratio of self-funding affect loan rate? Example 2. A business plans for a project which will require 1 million initial investment. The business will supply 0.1 million funding itself. It will apply for 0.9 million loan from a bank and plans to repay the loan in 1 year. A loan officer estimates the payoff from the project will be 1.3 million with 85% probability and 0.7 million with 15% probability. If a loan defaults, on average, the bank can get 60% of the salvage value. Assume the risk-free rate is 0. If the bank requires 2% return on its loans, what would be the loan rate? If the business will supply 0.2, 0.3 million funding itself and apply a loan for the remaining amount of capital, what will be the loan rates? What conclusion you can draw? Solution: the amount of loan is 0.9 million. The required payback is 0.9 times 1.02. This is 0.9 times 1 plus 2%. It is equal to 0.918 million. Assume the loan rate is x. Then 0.9 times 1 plus x times 85% probability plus 0.7 times 60%, which is the salvage ratio, times 15% probability. It is equal to 0.918. Solving the equation, we can get x to be 11.76%. When the part of self-funding is 0.2 million or 0.3 million, we can do the same calculation again to find the required loan rates are 10.74% and 9.41%. This shows that the higher the percentage of self-funding, the lower the loan rate. When you put in more of your own money, others trust you more. Discussion: how much trading in banks is funded by traders themselves or by banks? Most of trading in banks are not backed by their own money. Instead, they are backed by the understanding that the government will help out in case of insolvency. Should banks enjoy such low rates in their own trading activities? It is often said the causes of financial crises are complex. Are they really that complex? They are not complex. Trading with high leverage pursued because upside goes to participants and downside goes to the public. Projects with different lengths. In earlier examples, we assume project duration is 1 year, but project duration may be different from 1 year. We can perform the same calculation. Example 3. A business plans for a natural gas project, which will require 40 million initial investment. The business will supply 8 million funding itself. It will apply for 32 million loan from a bank and plan to repay the loan in 2 years. A loan officer estimates the payoff from the project will be 80 million with 90% probability and 24 million with 10% probability, depending on future natural gas prices. If a loan defaults, on average, the bank can get 70% of the salvage value. Assume the bank's funding cost is 2% per annum. If the bank requires 2.5% per annum return on its loans, what would be the loan rate? If the business will supply 16 million funding itself and apply loan for the remaining amount of capital, what will be the loan rate? What conclusion you can draw? Solution is 32 million times 1 plus x. Here x is the loan rate, and powered by 2 because 2 years, compounding in 2 years, and time 90% probability plus 24 million, which is the salvage value, times 70% is the salvage ratio, times 10% is the probability, should be equal to 32, that's principal, times 1 plus 2 plus 2.5. So this is 1 plus 2% is the funding cost of the bank, plus 2.5%, which is the required rate of return, and powered by 2, because compounding in 2 years. We use Excel to solve the problem, so we can look at the Excel result. So the amount of initial investment is 40 million. Self-funded part, in one case is 8 million, in the other case is 16 million. So the amount of loan in one case is 32, this is 40 minus 8. In another case it's 24, this is 40 minus 16. And the risk-free rate or the bank's funding cost is 2%. So the probability of two different payoffs is one is 90%, the other is 10%. So in the case of 90%, it's 80 million, and 10% is 24 million. And we get an average payoff. No, average payoff means not the payoff from the project, rather is payoff to the bank. I mean the loan, because the loan is one is $32 million, the other $24 million is average payoff to the bank. And then we can calculate salvage ratio is 70%, required rate of return is 2.5%, and the required payback, one is 34.95, the other 26.21. And we get loan rate. How we calculate loan rate? We change the loan rate so that average payoff to the bank is equal to the required payback to the bank. This means the required payback is equal to the average. That's how we get the loan rate. And we can see when the self-funded part is more, the loan rate is lower. Uncertainty and discounting. Different investment projects have different levels of uncertainty. How does this difference affect the loan rate? Example 4. There are two projects, each require $1 million funding. Each project will be liquidated in 1 year's time. There is 60% probability that liquidation value will be exponential S, and 40% probability that liquidation value will be exponential negative S, where S is equal to 0.3 for the first project and S equal to 0.4 for the second project. Suppose both projects are 20% self-funded and need to take 80% loan from a bank. Assume the bank's funding cost is 3%. The required rate of return on its loan is 2%. When the project could not make loan payments in full, the bank will take over the assets of the project. What are the loan rates for the two projects? Solution. The amount of loan is 0.8. When the project performs well, the company will pay back principal and interest. When the project performs poorly, the bank gets the salvage value. For the first project, the equation is 0.8, which is principal, times 1 plus x. Here x is the interest rate times 60% probability, plus exponential negative 0.3, which is the salvage value, times 40%. This should be equal to the required return. This is 0.8 times 1 plus 3% plus 2%. 3% is the funding cost from the bank, and 2% is the required rate of return. We can solve the equation to get x equal to 13.27%. Similarly, for the second project, the loan rate is 19.14%. Projects with higher uncertainty are charged with higher loan rate. This is consistent with our intuition. In the next example, we will discuss the relation between uncertainty and discount rate from another perspective. Example 5. A company has a choice to select one of the two projects. first project requires an initial spending of $10 million. For the next 10 years, the project will generate $3 million profit each year. The second project requires an initial spending of $20 million. The project will generate $3 million profit the first year. The profit from the project will increase 10% from each previous year. The project will last 10 years. The criterion of selection is NPV of a project. If the discount rate is 3%, which project you will choose? If projects are forced to close down after 3 years due to unexpected circumstances, what would be the realized value for both projects discounted at 3%? If discount rate is 10%, which project you will choose? With the benefit of hindsight, what discount rate one should use to value two potential projects? How should the choice of discount rate be related to uncertainty and our capacity in information processing? Solution: when discounted at 3%, NPV of project 1 is equal to -10, which is the initial investment, plus the cash flows of $3 million every year discounted for 10 years. The result is $15.59 million. The net present value of project 2 is equal to -20, which is the initial investment, plus the cash flows for next 10 years discounted by 3%. The result is $19.86 million. The net present value of the second project is higher, so we choose the second project. If projects have to close down after 3 years, we only have 3 years of cash flows. So the realized value of project 1 is -10, which is the initial cost, plus 3 years of cash flow discounted by 3%, which is equal to -1.51 million. The realized value of the second project is -20, which is the initial cash flow, plus 3 years cash flow. So it is -10.65 million. This is very high. From the above calculation, the second project causes much bigger losses. When discounted at 10%, the net present value of the first project is the same, but the discounting rate is 10%, we get 8.43 million. The net present value of the second project is 7.27 million. So the NPV of the first project higher, we will choose the first project. By choosing the first project, we will avoid possible heavy losses due to uncertainty. This is because the initial investment of the first project is smaller. Discussion: some people claim that since future is unpredictable, one should not be held responsible for losses due to uncertainty. However, if we acknowledge future is highly uncertain, we should discount future at a high rate. This will help us reduce the amount of losses due to uncertainty. Policymakers often attribute bad economic performance to uncertainty, but at the same time lower the discount rate. Are they being consistent? Project duration and discounting. Some projects last longer than others. How project duration affects loan rate. Example 6. There are two projects. Each requires $1 million funding. Project 1 will be liquidated in 1 year's time. There is a 60% probability that end value will be exponential s and 40% chance that end value will be exponential negative s, where s is equal to 0.3. Project 2 will be liquidated in 2 years' time. There is a 6% chance that the end value will be exponential 2 times s, and 40% probability that end value will be exponential negative 2 times s, where s is equal to 0.3. Suppose both projects are 20% self-funded and need to take 80% loan from a bank. Assume the bank's funding cost is 3%. The required rate of return on its loan is 2%. When the project could not make loan payment in full, the bank will take over the assets of the project. What are the loan rates for the two projects? Solution. The amount of loan for both projects is 0.8 million. For the first project, we have the following equation. It is 0.8 times 1 plus x. This means this is the principal and the interest rate return. This happens at 60% chance, so times 0.6 plus exponential negative 0.3. That happens at 40% chance, so times 40% should be equal to the required rate of return, which is 0.8 times 1, this principal, plus 3%, this is cost of funding, plus 2%, that's required rate of return. We solve the equation to get x equal to 13.27%. For the second project, it will last for 2 years, so everything should be compounded by 2, okay? And so the loan rate should be compounded by 2, and also required rate should be compounded by 2. And we solve to find y is equal to 17.48%. From the above calculation, projects with longer duration are charged with higher loan rate. In general, term structure interest rate curves upward. Interest rates for longer terms are higher. Next, we are going to discuss how loan diversification affects loan rates. In security investment, we know that diversification reduces risk. Does diversification in loans reduce risk as well? Example 7. Assume the bank's borrowing rate is 2% per annum. A business applies for 15 million loan for project and plan to repay the loan in 1 year. A loan officer estimates the payoff from project will be $30 million with 80% probability, and 10 million with 20% probability. If a loan defaults, on average, the bank can get 70% of the salvage value. If the bank required 3% return on its loans, what would be the loan rate? Solution. Suppose the loan rate is X. If the project is doing well, the bank will be paid back full loan with interest. If the project is doing badly, the bank will receive the salvage. Overall, the bank is expected to receive 15 times 1 plus X times 80% probability plus 10 times 70% salvage ratio times 20% probability, which is equal to the required rate of return, is 15 times 1 plus 2% plus 3%. Here, 2% is the bank's cost of borrowing. 3% is the bank's required rate of return on its loans. Solving the above equation, we get X is equal to 19.6%. This is rather high. Now we'll consider an example of loan to two projects. Suppose the company is planning two projects. Each project has the same payoff profile as the previous example. First, we assume the payoff of the two projects are independent. The distribution of the total payoff will be 60. That's 64%. This means both projects will earn $30 million, and the probability is 80% times 80% turn out to be 64%. And for 20, it is 4%. This means each project will receive $10 million, and the probability is 20% times 20%, which is 4%. And the other chances are one project receive 30 million, the other project receive 10 million. So the total is 40 million. And the probability for one is 80% times 20%, which is 16%. The other is 20% times 80%, which is also 16%. So here, the numbers in the parentheses are probabilities corresponding to the particular payoff. Solution. Two projects will need a total loan of 15 times 2 equal to $30 million loan. Assume the loan rate is X. If both or one project is doing well, the bank will be paid back full loan plus interest. If both projects are doing badly, the bank will receive the salvage value. Overall, the bank is expected to receive 30, which is the principal, right, times 1 plus X, is principal plus the interest, times 64% probability. And another term, same thing, except the probability is 32%. In both cases, the bank will be paid back in full. And not finally, there's a 20 times 70% salvage ratio times 4% probability, which is equal to the required amount. This is 30 times 1 plus 2% plus 3%. Solving the equation, we get x equal to 7.4%. The loan rate is 7.4%. This is much lower than the loan rate on one project, which was over 19%. We will do some further discussion. We know that in most cases, projects payoff are not independent from each other. They are correlated, for they are influenced by many common factors, such as general economic environment and the firm's internal environment. Next, we assume the payoff of two projects are positively correlated. Specifically, we assume the distribution of total payoff is the following. You can see this is different from the distribution in example 8. Okay, the numbers in the parentheses are probabilities corresponding to the particular payoff. Solution. The solution is similar to the last one, but the probabilities are different. So in this case, the bank is expected to receive 30 times 1 plus x times 70% probability. And the next one is 20% probability. And finally, in bad cases, it's 20 times 70% salvage ratio times 10% probability, which is equal to required amount of payment. And we solve, we find x is equal to 11.5%. This is lower than the loan rate on one project, which was about 19%, but higher than on two independent projects, which was 7.4%. Discussion. Diversified projects can reduce risk and hence reduce loan rates. Large companies often get lower rate financing. They are more diversified. Governments, as the most diversified institutions, generally have the lowest financing rate. From financial perspective, there are incentives for companies to grow larger and for governments to pick up more services. BC Hydro was established as a crown corporation to replace a private firm to lower financing costs before Burnett Dam was built. Similarly, banks prefer to grow larger through mergers. Then Liberal Finance Minister Paul Martin rejected two huge mergers in the late 1990s, RBC with BMO and CIBC with TD. Why the government blocked the proposed mergers? To further reduce number of banks will give banks too much power. In general, larger institutions will be more rigid. They become difficult to adapt to big change. In living systems, large organisms can withstand environmental variation better than small organisms. They generally have more fat reserves. Large companies often have more cash reserve as well, but large organisms are less adaptable to real big changes. It is more difficult for large companies to change their structure.
Discounting, long-term forecasting, and fraud. Low discount rate makes expected earning in distant future more valuable. This encourages long-term forecasting. Since we are less capable of forecast distant future, aggressive optimism and downright fraud often flourish in low discount rate environment. Summary: loan rates reflect down risk of investment project.